Inflation is falling across the world. When will the Federal Reserve and the European Central Bank begin cutting rates? How will the other central banks adjust their monetary policies? And what is the interest rate range in 2024? We have the answers in today's show.
And what's happened is the core inflation has come down quite significantly across the US, the Eurozone, and the UK. Now, that's partly because of all the global supply chain pressures that were a big problem in 21, 22. They eased quite significantly in the middle of last year, and we saw a lagged benefit from that in the second half of last year on goods inflation. And we've also seen some declines in services inflation. And I think as that's happened, the central banks have become a lot more confident that they've now raised rates to a level that they think is what they call restrictive, sufficiently restrictive. Policy is tight enough now, they think, in order to bring inflation back to target on a sustainable basis over the next 2 to 3 years, and get back to their inflation targets. So that's quite an important change, but what's gone with that change has been a very strong signal from central banks that they're not in any rush to start cutting rates. And so I think what we're going to be looking at is several months now in 2024 where the central banks are debating the outlook, and starting to talk about interest rate cuts, but we don't think they're going to get there for a few months. So we do see interest rates coming down across the world economy. In fact, we cover 20 economies in our global economic outlook, and the central banks in 19 of those economies are expected to cut rates this year. It's only the Bank of Japan that we see rates going up. So we do think that there'll be a widespread easing of monetary policy. So it is definitely a pivot year for monetary policy in our view. But we don't think rates are coming down quickly or rapidly. So we think the Fed is going to be probably on hold until June or July of this year. So that's quite a different view to what's priced into financial markets, but that's our view, that it will take some time for them to get comfortable with cutting rates. Remember, they've just been through a period. An inflation shock that nobody on the FOMC believed could ever happen again. I mean, there was a very strong view before the pandemic that inflation had been solved as a problem. So to have inflation, hit 10% and stay very high for 3 years, it was a massive shock to policymakers. So I think having been through this period, and with services inflation still quite high and quite sticky, and with labour markets still tight, still pressure on wage inflation, which is not coming down fast enough and is far too high, I think they're gonna wait for some time. Keep rates restrictive for another few months. So we don't see the Fed cutting until June or July. We think the ECB maybe a little bit earlier. And the reason for that is that the core inflation improvements in the Eurozone have been even more impressive than in the US. So core inflation has come down quite fast in the Eurozone. So we see the ECB going maybe a little bit earlier, but broadly, we think sort of Q2 for the Fed and the ECB. Bank of England, because core inflation is that much higher, we think they'll probably be waiting a bit longer. So probably more like Q3 for the Bank of England.
I think the year ended on a positive note in that sense, because I think most people feel that the US economy has achieved a soft landing, and the Fed came out and said that there will likely to be no further rate hike for that, right? So now the expectation is when the Fed is going to reduce the rates, right? And the market thought that maybe they will start reducing in the second quarter. But I think the expectation is that more likely, if inflation remains well behaved, the Fed will start cutting rates maybe in the second half of this year, but already, even though the Fed has not cut the rate, the interest rate has already come down. Right? If you look at 10-year yield, if you look at 2-year, 5-year yield, they all have come down. So it was around the high 4%, between 4.5% to 5%. Now it's in the low 4%. It's just above 4%. In fact, it went down to below 4% earlier. So everyone is in a waiting game to see, how inflation behave. And so there's a lot of noise. So, I think you're going to see that kind of a bumpy ride, going forward. When new data comes out, if it is a positive data, the market will rally, and so that'll be good for. But in any case, I think the higher for longer is no longer the baseline. Now the issue is how soon the Fed is going to cut rate and how quickly rates will come down. So once that, I think that has changed the setting for central bank in the region too, because many central bank in the region already peaked and are on hold as well, and they're waiting for the Fed to cut before they move themselves. But some of them may start cutting earlier, okay? Because if you look at the inflation dynamics in the region, inflation has come down much faster here than in the US, and many of the central bank are ready to cut, but they are holding back because if they cut, there's pressure on the exchange rate. The exchange rate of the countries in the region have already depreciated quite a bit. But because they are depreciating together, it's okay. They don't feel like they are the only one that's getting beaten up by the Fed. But certainly, I think they want to prevent the exchange rate from depreciating further or weakening further. Because if the exchange rate is too weak, there's a pass-through effect from higher prices of commodities into inflation. It is not a very strong pass-through, but it's there. And so most of the central bank, I would rather wait until the Fed cuts before they go along with that. Yeah.
Inflation has peaked, so we think policy rates have peaked. The Fed's going to be very careful because although inflation has fallen, one important part of inflation, which is services inflation, is still about 4%, so well above the target. And the Fed doesn't want to make the same mistake as 2021, where they let inflation get too far ahead. So we think they're going to go slow. We have three cuts penciled in for this year, but the first one's going to be the middle of the year. The market seem to think that's coming earlier, but the Fed and the ECB have been very clear that they're going to be very patient and wait. So again, as long as the labor market holds up, I think that's a slower reduction in interest rates. I think we're going to be around 4.5. And again, that's the baseline scenario. If we go into a recession, if the labor market really starts to weaken and growth starts to weaken, then of course the central bank will be more aggressive and we get more cuts. But the baseline gradual soft landing slowdown, 4.5 is probably a good estimate.
In many ways, the way to think about the Fed is not just 1 year or 2 years at a time. In lots of ways, if you look back at the 50 years, and try to figure out what the Fed's doing. We actually kind of use some machine learning on it, if you think about a statistic. They tend to have rules and they operate in the same way. That it's an institution that has certain ways of doing things. When inflation takes off, they're going to raise interest rates. And whether hawkish, they're doing it. That's kind of what the whole institution tells them to do that. There's a whole bunch of things. I think what they've kind of done is pretty much on track. And one thing that people who participate in capital markets know is it's very hard to predict either interest rates or stock prices. And there's mathematical and statistical reasons why. The basic reason is if I think stock prices are going to go up and everybody else thinks that, they would already make them rise right away. So the stock prices are a consequence of a whole bunch of people a lot smarter than I am trying to predict it, and they trade. It's very hard to predict future stock prices, whether they'll go up or down. That's kind of a fact. And same thing with interest rates. But they're kind of asked to indicate what they think the interest rate that they supposedly set. And they'll actually say, we don't know. But if you turn down an artificially intelligent machine learner, they'd tell you the same thing. It's just very hard to predict.